People can.
Oh, we have them both now.
Okay. Al and her? Okay,
Yeah.
good.
Getting like the looser end of it.
Good afternoon, everyone.
Hello?
Good afternoon.
Okay,
You all ready to go? You all ready to start?
we are live.
Okay.
Are we ready?
Yep, we are live.
Yes.
Good afternoon, everyone. Thank you for joining the Investment Committee for the St. Louis Public School Teachers Retirement System. Today is Thursday, November 21st, and I'd like to take a roll call vote, please.
Angela Banks,
Here.
Christina Bennett,
Present.
Lois Cross,
Present.
Sheila Goodwin,
Sheila, can you hear us? Sheila?
we'll come back.
She on mute. She's on
Emily
mute.
Hubbard, Shanice Johnson,
Present.
Yvette Levy, Martell
Can you
Mann.
hear me?
Oh, yep, we can hear you now, Miss Goodwin. Bobby Richardson,
Here.
Albert Sanders,
Here.
and Doris Walker.
Here.
So we have enough for our forum.
Okay.
Thank you, Sue. At this moment, I'd like to turn it over to Jeff to take us through the agenda for today's meeting. And thank you for being present.
Good to be here. So as I was complaining earlier, I said usually when I come from Chicago to St. Louis, I get at least a 20-degree bump in temperature, and I didn't get that today. It's chilly. So, but anyways, good to be here. So we have the quarterly report, flash report, and then a fixed income manager review. So, Gwelda, do you want to start with the reports or search?
I was going to say, I think she had the search first.
Okay, that's fine. We can kick off with that.
And then I can come in case, in case we don't have as much time. They've already seen the quarterly results, so I won't have to go in as much depth. We definitely need to get through this search.
Okay, sounds good. So what Sue has just put up on the screen here, this is and I'll kind of tell you how this evolved. So refreshing everyone's memory, we were primarily looking at the fixed in or the emerging market fixed income exposure, and said that's maybe a little too niche, a little too dedicated. We probably feel there's a more efficient way to do that through these more global managers like Neuberger, Berman, and Loomis, who sort of do everything in the global spectrum, but said rather than give another large chunk of money to two of the current managers, why don't we open it up and take a look and see what else is out in the universe? So we tackled it from sort of two perspectives. So let's just look at some pure global managers, but also maybe we take a look at what we call core plus fixed income managers. And those are managers that kind of look like Manulife and Earnest, but do a little bit more. So they can do things in high yield bonds and do things on the global spectrum. And we said, let's kind of see what they look like. Well, as we go through this and start taking a look at the numbers, you'll actually see there's a fairly marked difference between the two. And Sue, if you want to flip to the first page, we'll show you everybody that we're taking a look at here. So the first two, Baird Advisors, which their product is Baird Core Plus, that's a mutual fund. And then right below that, Loop Capital, that product would be a commingled fund, kind of like a mutual fund, but a little bit different. Those are the Core Plus managers. And when we start to go through the performance, you'll kind of see that they're going to be fairly different from what the bottom two look like. And that's PIMCO and their income fund, which also is a mutual fund. And then Wellington multi-sector credit, a commingled fund. So the bottom two, more of the global managers, they're sort of going to be more in that category that Newberger and Loomis are in. So when we initially started down the road, we thought, well, maybe the core plus managers look similar to the global managers, and there maybe just one makes sense. But as we started looking through this and saw the differences, we thought, well, we don't really think something like Baird or Loop really fits that global or, into that opportunistic bucket. We're probably going to want them somewhere up in that core bucket that we have the other managers, Manulife and Earnest. So our general thoughts as we go through this, we think that it's probably worth looking at least one manager within both of those categories. So sort of cheating and cutting to the chase, the two that we're going to talk about and emphasize today would be Loop on the core plus side, and then the Wellington multi-sector product on the global side. So, and we'll talk about why we would emphasize those two. But I think at the end of this exercise today, I think we want to do is see if it makes sense for everybody to have both of those managers in to make presentations in a future meeting, and then we can kind of go from there and see what everybody's thoughts are about actually allocating some assets to them. So again, I think from an allocation standpoint, the global is a little bit easier because we do want to move that emerging market money to one of the global managers. The core is a little bit of a trickier piece, because we essentially, to fund an allocation there, we would be taking money from current managers that have both done well. So, but we would be diversifying at the end of the day. And I know as part of the process, again, going back with a little bit of history, we had the Exponence fixed income piece in there that once that went away, we reallocated a good portion over to Manulife. So that would be a situation where we're sort of talking about taking some money from a manager that we gave some money to not too long ago. So again, a little bit more of a tougher finagle. But again, I think from just the pure standpoint of our job is to diversify assets and to do what's in the best interest here, I think we'll see that we've got a couple of managers in the search between Baird and Loop. And Loop is just, again, while we're sort of emphasizing them, they do a good job. It's really different from what your other two core managers do. It is an MWBE manager. So, certainly from the standpoint of that mandate here, it is great. They're right outside of Chicago. That their headquarters, right outside of Chicago. And again, you'll see as we go through the numbers, just looks like a good strategy and product. And from a fee perspective, you can see they're going to be one of the lowest out of this group. So certainly in line with, if not a little better than the actual median for strategies that fall into that core plus category. So, and again, on the global side, it's PIMCO, Wellington, two good managers. You can see the Wellington fee is quite a bit lower. So that's one thing we're certainly focusing on. Again, from the standpoint of diversity, Wellington has a very strong diversity policy. I got it back. A very strong diversity policy. Also has a female CEO. So again, a lot of good factors behind them. And again, competitive fee, a really good process. And again, sort of comparing and contrasting with how something is more of a fit for the total categories that we have there. PIMCO, remember, we have another strategy with them on the tactical asset allocation side. But PIMCO is very, although they can do anything on that fixed income equity, it still tends to be very fixed income heavy. And of that fixed income portion of the PIMCO Global Allocation Fund, there's a fair amount of overlap between what is going on in something like the PIMCO income fund and what they're doing on that tactical asset allocation. So we feel you probably get a little less diversification with the product. And again, as you see, we'll see the numbers, they're good, but I think from a total diversification standpoint, the Wellington product just seems like it's a better fit. So that's the Cliff Notes. Why don't we jump forward, Sue, to this page here. So this gives us a little bit of comparison of the overview of the firms. Again, not going to go through a ton of things here, other than just to give a general idea of. Oh, my buttons aren't cooperating on my computer here. So we can see where all these firms are located, what their ownership structures are. Again, from the standpoint of just total independence, you see that the Wellington Group and also Loop, they're 100% employee-owned firms. They all have, they're all sort of global with their scope and offices and individuals that they have really across the world that are doing research. These are all, again, institutional quality. They all deal with a lot of the money that they manage is on behalf of pension funds and other institutions. So they all have that scope. You can see just by the firm AUM, assets under management, that they all have, that these are very large, not a couple $1 million managers, but these are multi-billion-dollar managers that have been doing this for quite a while. So the section below where it says team information, again, you can see they're, for the most part, are all team managed, the exception sort of being the Wellington product. But again, I would sort of say, other than the fact it says there's sort of a single PM involved there, that there's still, as you see below, kind of a product management team and analysts that are behind them. Because how that's working, again, you have hundreds of different positions that they're looking at, and so they've got analysts that are really specialists in all of these areas, and then kind of bringing those up to the portfolio manager that makes the ultimate decision. But certainly it's one of those things that we do keep an eye on, because potentially if you have a portfolio manager change, what does that translate into? If a new portfolio manager comes in, do they do things radically different? So always something we keep an eye on. Not something we're having a major concern with this product, but it is something we have to watch a little bit more. Relative to something like Baird, where you see a team of 10 portfolio managers. So a little different dynamic there. But again, all of them have nice backing from their analysts and other support groups.
Hey, Jeff, this is Christina. I
Yes.
just wanted to say, for full disclosure, I
Sure.
currently have a relationship with Loop Capital Asset Management on their
Okay.
short duration fixed income.
Okay.
And so they've done very, very well for us. They may be the smaller firm, but they've got about 9 billion. They are minority owned, and they have done an amazing job for us. So we just put a 250 million in with Loop this year.
Okay. Great.
So I just wanted a full disclosure that I've been very happy with their firm.
Good. And you make a good point there too. And again, it's all kind of relative terms, that they're going to be the smaller of this group, but even at $9 billion, they're still pretty sizable. And Jim Reynolds has been around for quite a while and kind of knows the institutional space. And again, their team is all that they have right now was actually a lift out from another group. TCH, Gweld, is that right? Taplin, Canada. I can't remember what the H was, but in any event, so yeah, they sort of saw the need for having this type of strategy in the market, and so they brought this group in.
That was Jeff. That was the old Taplin Canada Hayback, Terry Canada, and
Yeah.
yeah.
Thank you. I couldn't,
Yeah.
the H always, jumps out of my head there. So, but anyway, yeah, good team, strong, it's still a fairly, critical amount of, assets under management and institutional focus. So, good. We're glad you, Christina, how long have you had money with them?
He's on mute.
Chris?
That's all right. So
Okay.
we'll move on here. So,
I think
and-
she said 250.
You said 250. I was just curious how long she had been with them. So.
I thought you said this year.
Oh, did you? Okay, I'm sorry.
250 million. this
Okay,
year.
good deal. Okay, so in any event, the next couple of sections just talk a little bit more about 30,000-foot view on the strategies. You can see the strategy assets under management. You can sort of see what their performance expectations and what they're managing against. Again, you're going to see a little bit of a difference between the two on the left, between Baird and Loop, and then the two on the right, because Baird and Loop are going to manage a little bit closer to the benchmark, which is the Bloomberg aggregate index. And then the other two, while they may loosely look at that as a benchmark, they're going to be not as constrained to that benchmark. So they can certainly be in positions in that benchmark, but will do other things outside of that. Again, such as emerging markets, high yield, and other niche areas of the fixed income market. So, and again, we'll sort of see how that's translated into not only performance, but also the overall risk levels within those portfolios. Let's jump down. Sue, if you want to jump to the next page. One more. Oh, can we jump down one page? Sorry.
One more page.
Yeah.
Okay.
Okay, so again, sort of a lot of different numbers on a page here, but just a few things we'll focus on. So you can see the top line under composition, number of holdings. So all of these are very well diversified products. You can see at the top end of the range, PIMCO with almost 9,000 holdings. So they do a lot within that portfolio, and Baird's going to be the second at 1,600, and Hartford 999, and even at 251. While for the Loop portfolio, while that doesn't seem like it's as much as 9,000, while it's not, it's still very well diversified at 251 holdings. So when we think about concentration in fixed income portfolios, it's when you're sort of less than 100 holdings. Is probably when you start to get a little bit more concentrated, and certainly we've seen managers that have even less than that. So 250 still very diversified. So middle section, you can get a general idea of static coupon, which is right in the middle of the average coupon. So that just kind of says if nothing happens in the market, if nothing goes on crazy with interest rates that moves the values of bonds up and down, this is at least what you're getting paid in coupon income. And again, while these numbers, what's great about these numbers, if you looked 12, 18 months ago, they weren't this attractive. So fixed income managers just didn't have coupons that were like this. So again, you can sort of see the two on the right, just because of the global nature and maybe doing things that are a little bit further down the quality spectrum, they get that higher level of coupon within their portfolio. And then Baird is sort of on the low end, but still a very attractive, almost 4% type yield that they get on their portfolio. So the segment right below that just gives a general idea of the various segments that these managers will invest in. Not surprising that just because of the size of the overall government issued bond market on a global basis, that a lot of these managers will have a good amount invested in government securities. Again, with where interest rates are relative to where they were 12 to 18 months ago, probably see a bit of a switch here. So some managers now starting to come back into the government market where they weren't before. And then the second tending to be within the mortgage-backed sector. So mortgage, and those were agency-backed bonds. So kind of like government bonds, but not the exact same government guarantee, but it's guaranteed by agencies of the government. So again, those are very, tend to be generally very high quality securities, but they are mortgages. So they will have some sensitivity to what happens with the overall interest rate market, in particular, longer term interest rates. And then the third segment will usually be in that corporate bond segment. So that's the one we'll probably expect to see a little bit more movement over the next couple of quarters, just because a lot of those valuations have become pretty heavy with interest rates now being at a higher level. There are more places within the fixed income market other than corporates to go out and get that return. So again, a lot of managers have a fair focus there. And between the two core plus managers, why are they going to be a little bit higher? Because that translates more into that Barclays aggregate benchmark allocation, and they're trying to stay within a certain bound of the sector allocations for that index. So that's why you see those running a little bit higher relative to the two global managers. So again, bottom line here, very, very well diversified across the different segments of the market. The global managers, again, have a little bit more of a latitude in their guidelines to shift things around amongst those segments. The two on the left between Loop and Baird are probably going to stay a little bit closer to the benchmark allocations in those areas. So the one thing I will point out, because I know it always stands out on a page and looks a little bit odd, is if you look down the PIMCO segment and you see some fairly big negative numbers, and that's in the cash segment. It's because they are doing a lot of things actually in the derivatives market, but it's not to say it's not taking on extra risk. So they're not using a lot of leverage through derivatives or anything like that. They're just using the derivatives market to express positions. So I'll give you an example. If they think, if they look at a Coca-Cola bond and say a regular issued out in the market Coca-Cola bond is giving us a 5% yield today, and then they go to the derivatives market, they call up Goldman Sachs or whoever and say, if you structure me a synthetic bond, which they can do through different structures that actually, at the end of the day, gives me a yield of 6%, I would rather do that than be in the actual cash bond. So they do that with a lot of positions. And what's the major downside with some of that? Well, they could potentially have a little bit more of a liquidity crunch. But again, that's why that large negative cash number, that's actually cash that is earmarked to basically be collateral for any of these derivatives positions that they take. So, and again, while it looks weird as a number on the page, we want to let everybody know that's not a large number because it's leverage. It's a large number because that's actual cash that backs up some of these derivatives positions. So again, I joke, and other people have joked too, that these PIMCO products are just listed hedge funds, because they can act like that because of what they do with derivatives, and they can take short positions and do other things, but ultimately their exposure ends up being the same as any other manager. They're just sort of taking advantage of liquidity differentials that happen on these trading desks. So people that make all these weird esoteric securities, nobody else knows how to value them. PIMCO does. It just says, hey, would I rather get 5% in the liquid market, or do I let Goldman structure me something at 6% and take on basically the same risk, maybe with a little bit of a liquidity piece to it. So just wanted to point that out. Again, we're not recommending them today, but just in kind of give everybody understand, because that is something that frankly exists in the global allocation product that we have in the system as well. So that sort of strategy applies there as well. Sorry, my machine shut off again. Okay, let's.
So let's fast forward a bunch of pages here to the quantitative review. That's page 10. And then 11. So page 11, these are the return figures. So let's sort of focus on mid and longer term numbers here. And these are the annualized figures. So you can see for the 5-year period, all the way down at the bottom, that's the Bloomberg aggregate. That's sort of the fixed income market. And we can see where that's
So
been.
I think you need to go back one page. He's saying the 5-year rolling. These are the.
Oh,
annual-
I'm sorry. Yep. I'm sorry, Sue.
There you go.
Yeah, they look exactly the same. So,
Okay.
yeah. So on the 5-year basis, you can see where the aggregate, that's all the way at the bottom, that's the index at 0.33%. So hasn't been a great 5 years in general for fixed income. And we know why, again, because of where the lower fixed income rates that we've had. The good news again, and as you sort of look at the shorter term, the 1 and the 2-year numbers, the 1 year in particular, the market has been at almost 12%. And that's just in recognition of we've had now that top off of interest rates. So when you have sort of a floor of 5 to 5.5% of just a coupon, you start with that return. And then when the Fed lowers rates, that is also a nice inverse relationship for the value of bonds. And that's where you get that extra, 5% plus on top of that coupon return. So the past year has been good on a look forward basis. Again, we think the Fed's probably going to slow down a little bit, just based on what we've seen with the latest inflation figures, and certainly with the new administration coming in, there's a handful of unknowns to kind of see where the Fed might be going. But sort of the good news on that is if we stay at this level we're at with interest rates today, we're still getting a pretty nice coupon return. We just don't know if we're getting as much as that back end turbocharge from the Fed still lowering rates. But again, still we think we still sit in a pretty attractive overall environment for fixed income. But again, you can see for the 5-year period, market not great. The top 2 managers in the core, and this is where I start to tell you where you're really going to see a difference in how these managers are structured, and you can see that it translates into some fairly different returns. So Baird and Loop both really good, 1.5%. So remember the market for that period's at 0.3. So while 1.5% pales in comparison to what we've seen in the equity markets on a relative basis, that means they've done a really good job of selecting credits and being in the right sectors and other areas where they can squeak out as much yield as possible in a market that just hasn't been that attractive. And then go up the spectrum to PIMCO and Hartford, who are a little bit more global, can go down a little bit in quality and some securities and do other things that are really additive to that yield. And there you see 4% plus returns. So for a market that's not great, those 2 managers have done a really good job in that structure. So going out a little bit longer term, let's go, because we don't have numbers for everybody for the 10 years. So let's take a look at the 9-year numbers. Aggregate at 1.72%. And then the 2 core managers, core plus managers, at just around 3%. And then PIMCO at a little over 5%. And then the Hartford product creeping up on 6%. So again, some relative to the market, pretty good returns on a look forward basis. We think that those numbers are even looking better than that. So again, having some structures that really can be more of a contributor to that fixed income piece on a go forward basis. One thing I didn't touch on were the ranks. And again, those are the numbers right next to the rates of return, to the right of all of those rates of return. Again, how those work, these are all in a universe of diversified fixed income managers. Again, you see a pretty meaningful difference in ranks if you go, let's just look at the 9-year again. The PIMCO and Hartford, those are both 1s. That means they are at the top of the universe. So those are really good returns relative to all other fixed income managers out there. Again, that has a lot to do with their structure, because this universe that we're looking at them against has a lot of these go anywhere, do anything managers, but also has some more constrained managers in it, like
Baird, and Loop. So, and that's where you see that differential for the other two. They're at 39 to 33. Again, better than median within the universe. That's good. Again, their numbers are better than the benchmark, but they're just a little bit different because of the more constrained nature of a core and core plus portfolio. Questions on performance? Okay, let's take a look at some risk. There's a couple of charts in here that I like, and Sue, these are going to be on page 17. Those squiggly lines confuse me, so I don't. Yeah, I tend to skip the squiggly lines because those are confusing to me. So these are the risk and reward charts, and let's just focus on the two on the right-hand side. Those are the 5 and 10-year period. So, and to refresh everybody's memory on how these charts work. So on the horizontal axis, that's the volatility, or it says STD, DEV. So that's standard deviation. That's just the volatility of returns. That says in any given year, what percentage above or below the average return can we expect the manager's return to be? So the more that number is to the right, so the higher that volatility, it just means the more in any given year the manager could be above or below the market. So certainly if you're always above your average, that's a good place to be. But the way statistics looks is it's looking how much you can be above or below. So we always pay attention to that in particular because we think about downside risk, and someone who can be up 8 percentage points above their benchmark can certainly be below their benchmark in any given year, 8 percentage points. So trying to minimize that sort of downside risk is something we think about. And when we flip to the next page, we'll talk a little bit more about that because we hone in that on that a bit more. But the vertical axis, that is the return. So that's the average that they have generated and that we think we might be able to expect on a longer term basis going forward. So again, the higher you go up, the better. So if you think about this in quadrants, so what we've done, there's the box that has those crosshairs through it. So the box is the index. And so we go through the index, their return level on a horizontal basis, and then their risk level on a vertical basis, and it creates these nice quadrants for us. And how you think about the quadrants is the top left quadrant is the best place to be. That means you are getting a better return on average than the market, and you're doing it while taking on less risk than the market. So that's kind of the best place to be. Worst place to be is the bottom right quadrant, because that says you don't get as good a return as the market, but you're taking on more risk. So you're not getting paid for the risk you take on. And then it's kind of debatable of the other two quadrants, which is better. Frankly, we kind of think the one where all of these managers are right now is going to be the better of the two because we're generating more return, but you are taking on more risk. But again, how to think about that is, if we are taking on more risk, let's at least get paid for it. But again, you can sort of see a market difference here between the two global managers because they're going to be, the returns are higher. But surprisingly, if you take a look at the PIMCO risk level, their risk is kind of in line with the two core managers, but they get a higher return. So the Wellington product, again, they're taking on more risk, but they're still getting paid for it. So we kind of think of that as if you were to draw like a 45-degree diagonal line through the square, the Wellington product is still going to be above that diagonal line, and so still has a pretty good trade-off for the amount of for additional risk that they're taking on. So again, it's pretty fair trade-off. And then the two core managers, they almost sit right on top of each other. So again, taking on a tad bit more risk than the overall benchmark, but they're getting compensated for it in higher return. So Sue, next page, and this is the chart I like even more. And this is upside and downside capture. Again, from a quadrant perspective,
we think about it the same way. So the top left quadrant is where you want to be, and we see all of the managers sort of sitting there for that 5-year time period. The 10's a little bit different. We don't have a full set of 10-year data for Hartford, so that's why they're not on that 10-year chart. But just sort of focusing on the 5-year, again, how to read this chart. So a little bit different from the previous, other than the quadrant concept is the same, but how this one reads, again, if you look at the square, which is the market, and the crosshairs, what this says is if you have a data point that's to the left of the square or the line, then that means when the market is down, the manager is down less than the market. So that's good. That's downside protection. And then the other one we want to look at is the horizontal line and being above that. If you're above that, that says when the market is up, are you up more than the market? So you can see all of those managers sort of fall into that quadrant for the 5-year period of when the market's up, they're up more. When the markets are down, they're down less. That's those are all pretty good trade-offs. So you can see, at least on a 5-year period, the one who protects capital the most is going to be PIMCO. And again, some of that's going to be due to, again, that structure that they have with derivatives, and sometimes also holding some excess cash. So the past several years, when fixed income markets have been a little bit more volatile and they've had some cash as a buffer within that portfolio, they've been able to garner some of that downside protection in that portfolio. So but again, Hartford has also done a very good job of being to that left capital protection portion. You can see their participation when the market is up is the best of the group. So when the markets are up, they're participating, and they're also doing a very good job of protecting on the downside. And again, you can see from the 2 core plus managers that they're going to be a little bit closer to the benchmark. But again, better returns than the benchmark when it's up, and protecting when the benchmark is down. So an overall good trade-off. This kind of leads back also to structuring when we talk about indexing, because remember, we've been pushing some things towards the index on the equity side, because we say there's certain areas of the market in equities where managers have a tough time beating their benchmark. Fixed income is one of those areas where we don't have that thesis. We say active, you really want to take advantage of active management in fixed income, because managers like this consistently do a fairly good job of beating their respective benchmarks. So that's kind of the bulk of what I wanted to focus on today. Again, there's a lot of other charts within this search that sort of slice and dice these metrics a little bit differently, but I think really that the 2 that we just focused on, the overall risk reward, are the managers getting paid for the level of risk that they're taking on. And this group by and large is, and then these upside captures I really like, because they tell a great story of, again, where I think we want to be with any manager. So again, depending on what asset class you look at across the system, the managers will just behave differently on these metrics. Some do a lot better, and we've got other asset classes where you just may never find a manager that's in that top left quadrant. It just so happens within this fixed income space, we have a number of managers that are there, and again, we love the trade-off. So I'll pause, see if there's any questions. And if not, I'll tell you, Gwalda and I are thinking on this, and we'll have to sort of think about calendars and in the next couple of meetings, is that we would want to focus on Wellington for the global, and then on Loop for the core. And our thought would be to have them both of them in for presentations as soon as practical. And assuming the committee likes what they hear, then we can talk about an actual dollar allocation to each of those managers and where it would come from.
Okay. Sounds good.
So if everybody's amenable to that.
Okay. Chris, Al, did you all have any questions or any other trustees have questions? Is everybody there? Hello?
No questions.
Okay.
Everyone's ready to call it.
Vice President, Vice Chair Bobby, Shanice? No questions?
No questions.
Okay. All right.
Okay, well, good. So we'll follow up with Sue just to figure
Okay.
out scheduling and,
Okay.
and look to have these managers in and hopefully we'll.
Well, December we'll talk about.
Yeah, right. And then that was sort of part of it.
January is the pacing study, so.
Right, which Gwilda and I talked about, and we think even if we wanted to do this January, we don't think pacing is gonna take up a lot of time.
Okay.
I mean, we think. we can-
Pacing won't take more than maybe 20, 30 minutes max.
Right,
Okay. They could each do 30 minutes.
we were at 30 to 40 and we can get the
Okay.
pacing in and then whatever we have performance wise, we can be summary, high level.
Yeah.
So,
Okay.
great, thank you, everyone.
Okay.
Thank you, Jeff.
Thanks so much, Jeff.
Yes,
Thank
thank
you,
you for coming from the snow, Jeff.
I came down here to avoid the snow.
Sorry for your loss.
Okay.
Yes,
Okay, what's next on the agenda?
Performance.
Okay. I hope it's good for your sake, Gwilda. Bobby's watching.
It is, well, put it like, it's good one period is not so good the next period.
Okay.
When you say that.
Okay, so you can bring up the quarterly report. I'm gonna do a brief overview of the market and economic environment that we were in the third quarter to kind of frame the discussion of the actual fund. So on the economy, as you all know, we had a 50 basis point decrease in interest rates. Go back one page to page 2. So on this, the economy, a 50 basis point reduction by the Fed in the third quarter of the year. And we've also had an additional cut in the fourth quarter, November of 25 basis points. So the economy is going, it was going very strong. Everything was actually looking positive. We had a lot of squirreliness with the elections. You'll see, to move to the next page, you'll see that the equity markets actually performed very well, both domestically and internationally in the third quarter of the year. If you look in the upper right-hand chart, you see that all of the markets actually, domestic markets had positive returns. Actually, mid cap and small cap, represented by the Russell mid cap and the Russell 2000, actually rebounded and did very well. As you know, large cap had been leading, but actually mid cap and small cap actually started coming back in the third quarter of the year. In the middle of that top chart, you see the international markets, the ACWI ex-US, the IFA, both the developed markets, as well as areas that were non-developed, and also the emerging markets. As you can see here, emerging markets and international actually had the highest return at 8.7%. And even below that, the fixed income markets did really well relative to what they have been doing in the past. In the third quarter of the year, the Bloomberg aggregate, which is the broadest measure in the domestic fixed income markets, had a return of 5.2, and so it was a very good quarter for the markets, and you will see that for your fund as well. If you look down below in that lower chart, you'll see those are the returns for the past year period ending September 30, and you see very outsized returns with over 36% in the S&P 500, the Russell 1000 representing large cap stocks, both growth and value, 35.7. And Russell mid cap and Russell small cap, both over 25%. You also see double-digit numbers in the international markets, all over 24%, and you've got nice returns in fixed income in the 1 year period. One of the reasons that the international does so well is the weakness of the dollar. As a result, you saw good returns in that portion of the markets. Turning over to page 4, Sue, we saw a reversal in style in the large cap portion of the markets in the third quarter. As you all know, growth has been the place for the last several years, actually. And if you see here, the blue bars represent value stocks in the third quarter. And if you look at the Russell 1000 value, which is the second set of bars, the values of the 1000 value, 1000 growth, as you can see there, the value far exceeded the large cap growth index in the third quarter, 9.4 versus 3.2 for the growth index. We also saw this in the small and mid cap portions. Mid cap value returned 10.1, whereas mid cap growth returned 6.5. And the Russell 2000 value, the small cap stocks, returned 10.2 versus the Russell 2000 growth returned 8.4. So you saw a style reversal, and that's one of the reasons we diversify by style, both in large cap and well as small and mid cap, so that you have a more smooth return stream in your equity segments of your fund. At the bottom of the page, you can see illustrated here what I just mentioned, that growth had been the place to be. In the large caps, more specifically than in small and mid cap. So the 1 year numbers ending September 30, you see that the the growth indices represented by the red bars actually exceeded value significantly. In the 1 year number, the Russell 1000 growth returned 42.2% versus the value at 27.8. And a lot of those growth stocks are also those Magnificent Seven that we talked about quite a bit. They're in that index. And then you see at the bottom, the mid cap and the small cap, they're pretty much in line with each other during the quarter. So if you'll drill down to a little bit to the next page, this goes by industry. As you can see here, the darker blue represents the quarters and the lighter blue represents the 1 year numbers in the large cap indices at the top. And as you can see here, all segments are in, I should say, economic sectors actually were positive in the third quarter of the year, with the exception of energy. In the 1 year time period, all positive, and energy slightly positive. So actually good performance across the board in all different segments of the market in the third quarter of the year. At the bottom, you'll see in the Russell 2000, which represents smaller cap stocks, you'll see the same patterns repeated. And energy actually had negative returns for the past year, and even for the quarter, for the 1 year, the quarter and the 1 year, negative 9.1 for the quarter, negative 7.2. So in general, good participation by all different segments of the market and different industries. If you turn over to, so we're going to go forward a little bit. We're going to go over to fixed income, which is on page 9. Go back one page. There we go. As you can see here, there we go. As you can see here at the top, those are the different segments of fixed income: treasury, mortgage, investment grade corporates, high yield, and tips. U.S. investment grade corporates actually did best in the quarter with a term return of 5.8. The not AAA, but some of the not junk bonds, but you see there the BAA and single A in the middle actually did real well. And if you look at that last set of bars at the top, you'll see that the global ag, which is international bonds, actually have the strongest return, owing to the weakness in the US dollar at 8.5 for the quarter. At the bottom, you see this repeated good, solid performance in all different segments of fixed income in the 1 year numbers. So you can turn to page 10. At the bottom of this page is the yield curve. And then the bulk of this is inverted, which means that you can look here, the lower or the shorter term bonds, which are on the left-hand side of the chart at the bottom, actually had higher returns than the longer term bonds on the right-hand side. But if you can look and see, I don't know if y'all can see that blue line at the bottom is as of 9/30/2024. And you start to see a little bit of an uptick and a little bit of movement for the yield curve to move in the right direction. It should be sloping down up rather than up down. And that is due to the cut in interest rates. We're starting to see the longer term bonds, which should be paying more because you're taking on a risk by being further out on the curve. So we started to see uptick. Now, I don't know what's going to happen. As you all know, we have a new administration coming in next year. A lot of stuff is up in the air. Actually, you'll see in your returns, October was not a good month for the markets. November, we've been back and forth. Actually, we hit some highs in the markets. As you all know, we topped 44,000 in the Dow, and we believe over 6 in the S&P 500. I looked at it today before we got on, and we're right at 43.9 for the Dow. And the S&P 500, trying to see, did I write it down? S&P's at 59.48, closed at today. So still okay, but there's a lot of volatility, and I think a lot of it's due to the uncertainty of what's going to happen. There are some things that are being talked about, put in place that could cause some pain. As Jeff referenced earlier, we may have a pause with respect to rate cuts because there are some things that are being spoken about that could actually make inflation start to increase again, and that would cause the Fed to pause. So we'll see what happens there. As far as goods and services are concerned, we may see some increases in the prices of goods and services because of two factors. One, if tariffs are imposed and actually actually can go through, tariffs on products coming from other nations, as well as in China. I think he said a 60% tariff on China and 20% on other countries. What's going to happen is the companies aren't going to eat that. It's going to be passed on to the consumer. So some goods are going to become more expensive for us as consumers. In addition to that, agriculture, where a lot of our agriculture comes from, is from California, our products. And if there are mass deportations, there should be an expectation that some products that we consume will go up because there will be fewer people to harvest those crops from the fields, and also in some services, like especially in the building industry, where we have a lot of the people from other countries actually are part of the building trades. There'll be fewer, so which means the cost of those services will go up. So there's a lot of uncertainty, and a lot of it will be dependent upon what can be pushed through, or what can be pushed through as far as some of the initiatives or things that the incoming administration has mentioned that they might be doing. Any questions or discussion before I go into the report itself? Okay, so you can move over to page 12. Okay, as you can see here, all segments of the plan actually are within range. The target ranges, as you know, the little inverted triangles are where you actually sit in percentages in the different segments. And we are all within, the gray bars are the ranges to make sure you stay in line with your asset allocation that's been voted on and approved. And as you can see here, all of your segments are within range, in the targeted range. If you turn over to page 13, you'll see the difference in market value from the end of June to the end of September. As you can see here, the fund went from 846,566,592 to 867,413,265. A nice increase in market value as a result of the good returns in the market. Now, Sue, if you'll move forward to page number 16. Okay, on this page, as you know, we show you the fees on an annual. Every year we show the fees every quarter, but once a year we actually look at how these managers look versus the median peer group in each of these different managers. And as you can see here, the ones that are over the median peer is TC. They're in red. TCW large cap. They actually charge 60 basis points. And the median peer is 55 basis points. Westfield is your small cap growth manager, has a 1% fee. And the median annual fee is 81 bips. So that's quite a bit of difference there. Systematic, which is your small cap value manager, has 94 basis points and the median fee is 79. Then if you go down the page, Invesco Emerging Markets, there's not much you can do to that as a fund. It's an 85 bips and the median fee is 71. Manulife and Earnest Partners, actually, they're not significantly over, but Manulife is 27 basis points. Earnest Partners is 25, and the median peer annual fee is 21. Lazard, the EMD manager, one of the ones that we're looking at making some changes with, they are charging 75 basis points, and the median peer is 41. And PIMCO All Asset Fund, it's also a fund, is 87 and the median is 85. And there's not, I mean, that's negligible. I don't think the 2 basis points is anything we'd be concerned about. Jeff and I can have conversations with a couple of the managers where we see the biggest fee differential, like Westfield, Systematic, to see if we can look at reducing or negotiating down a lower fee. I thought we'd had conversations, but
Yes, well, I know we talked to Westfield and they're the one that did not move. I think we did
I
have,
thought Systematic made a change for some reason.
yeah, and I
I
think
couldn't find it.
Manulife came, yeah, I think Systematic, I believe, we need to double check, make sure that got reflected. I need to double check what that fee was. And then I think Manulife we had come down as well, so.
Okay.
It also looks that, and again, we'll have to double check on this too, because the universes, the median peer universes tend to change year in and year out too. And I suspect if we sort of take a look at this relative to where it was last year, again, I can pull up last year's report, that I think in the fixed income area in particular, and probably some of these other areas, that some of those medians have come down, and I think that's just going to be fully reflective of the fact that when markets are not as good, and in particular fixed income, a lot of folks have really been going after and renegotiating their fixed income manager fees, just because the environment has not been great. So I suspect we've probably seen a lowering across the board. So certainly something we'll take a look at to see if there's not other, additional areas to renegotiate. Again, we can't really do anything on, on Lazard. Again, that's one that we're looking at anyways. So eventually that one probably comes out. Again, PIMCO not too far off its mark, but that's a mutual fund. Can't really do anything there. And honestly, still again, we'll have to double check the fixed income, because those 21s are looking pretty low. So we'll have to kind of see what happened in that universe, because frankly, the Manulife at 25 and Earnest, or sorry, 27 and Earnest at 25, those are still,
that's low,
pretty low relative to the universe. So
right. Okay. All right.
We have like a tiered, so much is
And the thing is about it is that some of them were just now hitting the first break point. So you're not going to, even if you saw a change, it might not be enough in the amount that they're managing to really see a change, even though we might have hit the first break point. Okay. You can turn to page 7.
I have a question.
Yes, ma'am.
Okay, just because they in red, do it mean that they are on our watch list? I know
No,
manual.
this is not the watch list. No. This is the fee. We look at the fees, how the fees that they're charging the fund compared to the average in the industry for that particular type of management.
Mm-hmm.
That's what this is. This is not the watch list. Watch list is at the back of the report.
Okay.
Yeah.
Okay.
Okay. Page 17, so we'll move forward. As you can see here, with the exception of systematic, all of the managers are exceeding the commission goal in their different segments. Lomax, TCW, and Westville in the domestic equity. Causeway's done well above what is asked in the international portion. Ernest Partners, well, significantly above in fixed income, and in global equity, Exponents is also exceeded. We can speak with systematic. We'll see where they are. We still got one more quarter to go. But it's doubtful that systematic will be able to meet the 33.3% if they're at 21% MWD commission year to date through September 30. Move forward, Sue, to page 19. This will give you the totals for the cash flows for the quarter ending September 30. As you can see here, 19, Sue, I think it's the next page. Yeah, there. Okay, so you can see the market value at the beginning of the quarter was 846,566,592. Contributions of about $4.8 million. Lot of distributions, about $26 million in distributions, was inclusive of benefit payments and expenses. Management fees of $233,952. Other expenses of $33,523. A nice pickup in market value, increase in market value of $42,356,004 to end the quarter $867,413,265. They were looking at about approximately $8 million a month, looks like, coming out in payments and expenses, benefit payments. Okay, Sue, if you will move over to page number 27. Okay, this is the returns of the fund in the third quarter. As you can see at the top, the fund returned basically 5.1% in the third quarter, did not meet the policy index of 5.41%, and the ranking did not look that great at 70th. The 1 year number is around 17.7, below the policy index at 19.4. All the other numbers are, the 3 year number isn't as strong, but if you look at the 5 year number, the 10 year number, and the since inception number, they're all in line, pretty much in line with the policy index and actually exceeding it in the since inception number. We're still shy of the 7% that is needed since inception, and we're continuing to work on trying to bring that number up. If you drill down the page, you can see where the weakness was. If you see total domestic equity, actually at 6.59%, but the weakness in the domestic equity that did occur occurred in the large cap value portion of the fund. You see here, if you go down the page to Edgar Lomax, which is your large cap value manager, had a return of 8.31 when the index returned 9.43%. Edgar Lomax, as you all know, they were in a few months back. They're a very conservative value manager. The stocks that performed best in the value index in the third quarter were the higher PE value stocks, and they focused in on the lower PE as a result. They did not do as well as the Russell 1000 value, but if you look at them versus their peers, they still rank well above the median of peers at 40th. As you know, they've been challenged somewhat over the past year with respect to the returns being off in the 1 year period at 24.35, nothing to sneeze at, but not as strong as the Russell 1000 value at 27.8. If you look at the long-term number, they're right in line with the index, not ranking as well as other large cap value managers. As you all know, we did have the discussion, and the board did vote and approve to take 20% of the assets from them and put it in an index, which is, I believe, Sue, is supposed to be next week. That money is supposed to transfer over to an index fund with your custodian, with the custodian. So we'll see the same type of structure that we have in large cap growth. We'll remove some of the large cap growth active managers money to the growth stock index fund. So we'll have the same type of structure. We'll have an active manager as well as a passive, which allows us to, when those indices do well, to pick up some of that return, as well as have active management, which really pays off when the markets decrease. So we'll have the same type of structure in large cap growth and large cap value. Sue, if you can move over to the next page. TCW is your large cap growth, active large cap growth manager. As you can see here, TCW actually underperformed in the third quarter, returning 1.54 versus the index at 3.19. The 1 year number, they actually done well. They rebounded, I believe it was last quarter. And the return, and for the 1 year number, is really good at 44.3% versus 42.2, and they ranked 25th for the 1 year number. We did remove a portion of their assets, we removed a portion of the assets and we put it in the index. Well, no, excuse me. The manager that we terminated, we took their money, which is another active large cap growth manager, and put it into Mellon Large Cap Growth Stock Index Fund, so that we could pick up some of the return that was coming from the Magnificent Seven that most large cap managers would not concentrate as much as that index. So that's what's going on there. This particular quarter, TCW's underperformance was primarily due to security selection in the information technology segments, discretionary and industrial sectors. If we drill down into the portfolio, we look at the other managers in the small, mid, and micro cap. As you can see here, your small cap growth manager represented by Westfield and your DFA micro cap manager, both were in line with or exceeded their respective benchmarks, and they also ranked well, significantly above the median. Westfield at 25th percentile and DFA at 32 percentile. Systematic underperformed during the quarter with 9.3% versus 10.15, but they still look really good versus their peers, ranking 33rd. And if you look at the longer term numbers for Systematic, no concerns. As you can see here, if you look across the page, Systematic has actually ranked above the median of peers and exceeded the market benchmark in all other time periods shown here. If we drill down now to the international developed, as you can see here, both managers, both your growth-oriented manager represented by Fidelity and International Developed, and Causeway, your international developed manager with a value tilt. Both of those managers exceeded the benchmark and ranked well above median. Fidelity at 38th and Causeway at 27th. So no reason for concern in the developed equity portion of the fund. So if you move over to the next page, we have our emerging market equity managers. You have DFA again, and you have Invesco emerging. We saw difficulty with both of these managers in the third quarter, with DFA returning 5.8% versus 8.72 and ranking 58th. Invesco, who was in a couple of quarters, well, I guess it was in October, it actually came last month, returning 4.74 compared to the emerging markets index at 8.72 and ranking 80th. In the discussions that were held last month with that manager, she indicated why their performance had been the way it had been, and also gave their outlook on some changes that they were seeing occur, as well as within their allocations within. So we will continue to watch for improvement of that manager going forward. If you look at the longer term numbers for DFA, less concerning. On the 3-year, 5-year, and 10-year numbers, and since inception, they've exceeded the market benchmark, albeit not ranking as well with the emerging markets index. And as I mentioned, Invesco emerging markets, we're going to be looking at that closely going forward to see if the changes and the indications she gave us with respect to the portfolio, if they actually come to fruition going forward. Exponence is your global manager of managers, slightly under, but pretty much in line for the quarter with a 6.63% return, ranking 40th above the median at 6.61. You brought on this account, this manager in 2020. The since inception number is right at median with a 10.8% return, and the MSCI World Index at 11.5. Page 30, Sue, is fixed income. At the top, you've got your domestic fixed income managers represented by Manulife and Ernest Partners. Manulife outperformed and has outperformed in every period measured and ranked above median in all periods. Ernest Partners hit a blip this time with a 5.1% versus 5.2 for the Bloomberg aggregate, but the longer term numbers are still compelling, exceeding the index in all time periods measured, so no concerns there. Jeff has already done quite a bit of talking regarding the opportunistic fixed income. As you know, the one that we have the biggest concern about is Lazard EMD, which is represented at the bottom of this page. We did find out, if you look, one of the ones that we had concern about, but we found out their portfolio is actually hedged. So if you look at the Neuberger Berman hedged portfolio, it's a 4.73, and the Bloomberg aggregate hedged is 4.24. So they actually have exceeded that hedged benchmark for the quarter, and their numbers look more in line and actually exceed in the 1-year number, the 5-year number, and since inception numbers, they actually look much more compelling versus the hedge. So the biggest concern we have here is in the Lazard EMD. And so we'll be looking at making some possible recommendations and changes with respect to that manager going forward. Page 31 is the PIMCO all assets or the global TAA. As you can see here for the quarter, did not do well versus its benchmark at 5.94 versus 6.61 and ranked below median. This particular manager has had a tough time within the last 3-year rollings. But if you look at the long-term numbers, which is what we would like the board to focus on, the committee to focus on, PIMCO All Asset has exceeded the benchmark in the since inception, the 10-year and the 5-year numbers. Hedge funds actually did their job. They've done well. If you look down here, the ones that are actually not in liquidation, which are Whitebox and Grosvenor, both Whitebox actually exceeded its benchmark at 4.9 versus 2.2. You look across the board for that particular manager, they've been hired in 2014 and they have exceeded their benchmark in all time periods measured. Grosvenor, pretty much in line, 1.9 versus 2% for the quarter, but slightly off. But if you look at the longer term numbers, Grosvenor has also exceeded its benchmark in all other time periods measured. And then the last page for the manager comparisons is on page, the next page, which is real estate. And as you can see here, remember we came out of the redemption, the U.S. Trumbull Fund for this quarter. We're actually starting to see a little bit of a turn in real estate. The Trumbull Fund was pretty much right in line with the Odyssey at 0.01 versus 0.02. And the Property Income Fund actually exceeded the Odyssey at 0.41 versus 0.02. And that fund, if you look at it across the income fund, if you look at it across the board, it has actually exceeded that Odyssey in all time periods measured, albeit not as strong of returns versus its peer group. Any questions on that before we go to the actual watch list and then bring you forward to the October numbers? Okay, so if you'll turn to page 83. Okay. At the top, you see Edgar Lomax. We've already addressed that with some of the values that we pulled from them. They are on watch per your current watch list policy. We still have yet to review and put in a change for what we recommend is a longer time period, a 3-year rolling and a 5-year rolling rather than a 2-year rolling. So we need to get with the, I guess it's the Rules and Regs Committee in order to look at possibly changing those measures in the investment policy document. Invesco Emerging Markets Equity, as you see, that's still on watch. And as I mentioned earlier, we will continue to watch them. Exponents actually fails in the 2 and 3 year time period versus the peer group as well as the market index. So they are on watch. Lazard EMD, we're trying to address that now, and the PIMCO All Asset also are all on watch. So you've got 5 managers on watch per your current investment policy guidelines, watch list guidelines. Any questions regarding the third quarter before we move forward to October flash report?
Okay, you said we have 5 managers that are on the watch list.
Yep.
Okay, so what do we do about it? You just keep watching, monitoring?
Well, we've already addressed Edgar Lomax.
Okay.
We pulled funds from them. And the Lazard EMD, we're addressing that with the search that Jeff went over earlier. Invesco, we have them in, and we want to wait and see if what they're saying is actually going to come to fruition. If not, we may have to do something there. Exponents has really not been with you but 3 years now. So that's a very short time period to really look at making any major changes with the manager.
Yeah, 2020 is when they.
Yeah.
Isn't that a kind of high number of?
Well, that's because that's why we want to address your watch list policy. Most and Jeff, please jump in here if you'd like. Most watch lists don't measure managers on a 2-year time frame.
Well, that's too close.
It's usually 3 years or 5 years.
Okay.
Okay.
Right. We just
That's why we're proposing putting forth a different measure of time in the watch list.
Okay. That's fair.
So that means that our committee had to make some changes in our rules and regulations. That's what
I think that's what Sue told us, that comes through that committee. And then I think it has, before we can make any changes in the investment policy document, that has to go through that committee. Am I correct, Sue?
That's right. That's typically how it's done. And then obviously then it's presented to the full board.
Okay. Just asking.
Yeah, no problem.
It's a good question because it's in the document and we cover this, and this is directly coming from your policy. But I think what we've sort of realized is that with a lot of the short-term market volatility, and it seems like these days we have a lot more of that than we did 10, 20 years ago. And because of that, when you have these shorter term factors, you will get this situation where a lot of managers are getting what we kind of call false positives or false negatives, or however you want to look at it, of just something that we probably really shouldn't be watch listing just because the time period is so short here. Again, other than, I mean, the ones that we are reviewing right now that we did review, so Lomax, which we did a reallocation, and then Invesco, I'd say it's sort of the next one that's kind of on the list. And then Lazard, I think we have that sort of slated to be reallocated, but then the others where we really haven't come in with anything hard on it, it's, as Gwilda said, probably too short of a time period. And we think that some longer term metrics sort of tell us something a little bit different than what we see here, so.
Okay, okay, thank you.
Okay. Sue, if you bring up the October flash, and I may take you guys over by 5 minutes, but it won't take me long to go through this. Okay, you'll turn to page 1. Okay, this kind of lets you see September was a great month, and it was the third quarter was a great quarter. But as you see here, October, we see some negatives, and unfortunately negatives across the board. On that first column, it says month, the S&P, mid cap, Russell 2000, both value and growth were down. And the most down was actually the international markets, the EFA and the MSCI Emerging Markets Index. As you can see below that, the fixed income, the broad market, fixed income market, Bloomberg aggregate was down 2.5. International bonds was down, or global bonds down 3.4. So not as good a month as what we saw before. If you turn to page 2, Sue, you can see all segments are all within range still, and the market value, because of the correction in the market, was down. The market value decreased down to 847,340,074. Now, Sue, if you'll go over to page number 3, this is the returns of the total fund, albeit a tough month in the markets. Your managers collectively were able to protect you on the downside, the active managers, with a return for the fund of a negative 1.62 versus if you had been indexed across the board, you're down a negative 1.88. For the 1-year number ending October 31, you still have an 18.31% return. And versus the policy index at 19.47. Longer term, the fund is pretty much in line with the policy index in a long-term period since 1987, a 6.9% return versus a 6.6, which is right on top of the 6.9 is right on top of your actual assumption rate. If you look down the page, you'll see how your different managers perform. In the large cap value segment, basically Edgar Lomax was right on top of the index at a negative 1.1, and the value index was a negative 1.1. TCW large cap growth actually rebounded and delivered positive numbers in what was a negative large cap growth market at 0.57 versus a negative 0.33 for the index. Turning over to page 4. You have the small, micro, and mid-cap managers. And as you can see here, Westfield underperformed for the month at negative 2.6 versus negative 1.33. But Systematic actually, which you saw, remember, did not do as well in the quarter, found it and was able to protect on the downside with a negative 1.37 versus a negative 1.56. DFA, your micro cap manager with a value focus, slightly under the micro cap benchmark, a negative 1.9 versus a negative 1.44. And international, Fidelity, which is your international developed growth manager, actually protected with a 5.9%, negative 5.9 versus the benchmark at a negative 6.2. Causeway under, but long-term, nothing to be concerned about here. Down for the month at a negative 5.3 versus a negative 4.7 for that benchmark. In your emerging markets equity, which I showed you on the first page, I actually took it on the chin this month. As you can see here, both DFA, emerging markets value manager, as well as your Invesco manager, actually protected in a very difficult market, losing less than that MSCI emerging market index. Turning over to the next page, page 5, you've got Exponents, your global manager, protected on the downside as well, losing less at a negative 1.4 versus a negative 2.2 for the MSCI World Index. And on page number 6, you've got fixed income, core fixed income. Actually, this time Manulife lost a little bit more than the index at a negative 2.7, and Ernest Partners was slightly less, lost less than the Bloomberg aggregate, a negative 2.43. When you look at opportunistic fixed income, Lumen Sales Strategic Alpha did well on a relative basis, a negative 0.38 versus their custom benchmark was a negative 3.3. The tips, of course, is just mirrors what's in the tip index. Neuberger Berman, the manager, actually did not do as well as the hedge benchmark at a negative 2.24, rather than negative 1.4. Lazard continues to underperform at a negative 2.62 versus a negative 1.84. Hopefully we can address that and get that rectified soon. So if you move over to page 7, you've got your global tactical asset allocation manager, PIMCO All Asset, did not perform as well as its custom benchmark, at best the negative 3.0 versus a negative 2.5. On a long-term basis, though, if you look at the 5, 10 years since inception number, albeit the shorter term numbers are more challenged, they've exceeded their benchmark on a 5, 10, and since inception number. And your hedge fund managers continue to do well. Both White Box and Grosvenor both exceeded the hedge fund multi-strat index at a 1.5 versus 0.4 for White Box and 1.24 versus 0.38 for the HR fund of funds index in the month of October. And of course, real estate don't report on a monthly basis. So we don't have numbers, of course, for that. And that rounds out your performance through the end of October. And we're almost at the end of the year. And unless something catastrophic happens, we will see decent positive numbers for the whole year of 2024. Any questions of myself or Jeff?
Great report. I appreciate it.
You're welcome. Thank you.
Yeah, great report.
Even though we got negatives in October, we're still looking good. We're still looking good on a 1-year number or year to date. We're still looking good.
Right.
Okay.
If November holds on, we're getting a little bit back in November. So
Yeah.
Okay. Anything else on the agenda, Sue?
I guess we just need to decide about the December meeting, what the trustees, the co-chairs would want to do for the December meeting.
Last year we canceled it unless we needed. Do we need to have a meeting? Is there any decisions we have to make?
It was going to be performance. Is that what was the
November performance?
I'd say if we were dead set to have it, then we could probably see if we could shoehorn those managers in. But again,
yeah,
if we don't go out, I don't think we outside of the managers, we really didn't have anything else for December.
No.
Merry Christmas.
Again, we could.
Who's that? Is that Miss? That's Mrs. Sanders.
I think that was Al's.
That was Al's vote. Decision for us.
That was Al's vote.
Yeah.
So are we meeting in Al and Christina? We have to have a vote on it, right?
Well, we don't have to vote on it.
Okay.
It would just be.
So
it would be December 19th if we have.
Yeah, the 19th. So what's the pleasure?
Pleasure is to not have a meeting and enjoy our holidays.
Okay, we heard it from one of the co-chairs. We didn't hear it from the other one though.
I can say Merry Christmas.
Yeah, we want to celebrate the holidays.
All right.
Oh, happy holidays. I'm sorry.
All right.
All right. Well, I won't see you all till next year. So have a wonderful Thanksgiving and a Merry Christmas.
Same to you and Jeff, and thank you all for all.
Oh, look at the baby.
She's saying happy holidays.
Happy holidays.
Thank you. All right, thank you so much.
All right.
Happy holidays to you as well.
Thanks. If there's no other further business, can I get a motion to adjourn? And thank you, Jeff, for coming into town.
Yeah, thank you, Jeff.
Good to be here. So, Sorry, I missed a lot of you out on the conferences this year. So.
Okay, okay, great.
All those in favor, please say aye.
Aye.
Aye. Thank you, everyone.
And I would
Okay.
ask everybody to
Okay,
stay
happy
on.
we-
holidays.
You don't have to get off during this meeting and start the other meeting, and you can stay.
Yeah.
We have that,
Election.
She asked everybody to stay on. Everybody's leaving. She asked everybody to stay
No,
on.
don't leave yet. We have one other order of business.
yeah.
It's not gonna take long.
Number 2.
Somebody can turn off. Let's make a deal.
All right. So,
Football. You know I'm watching football.
All right. Okay. So are we're done with that meeting? So.
Yep.
All right. The purpose of this second meeting is for the Board of Trustees to elect a treasurer to serve from January 1st of 2025 until December 31st of 2025. In the recent election, Trustee Gooden is who is our treasurer, and we're going to honor her for her service to our board. There is a new person now that is coming on, and that would be Jennifer Orr. So as a trustee to replace the active teacher spot. So at this particular point in time, I wanted to know if, okay. Roll call vote to just start this meeting. Okay, we're gonna do a roll call vote to start this second meeting.
Angie Banks,
Here.
Christina Bennett, Lois Cross,
Here,
Sheila Goodwin,
Here.
Emily Hubbard,
Here.
Shanice Johnson,
Present.
Yvette Levy, Martell Mann, Bobby Richardson,
Present.
Albert Sanders,
Here.
and Doris Walker.
Present.
All right, so we do have a quorum.
okay, we have a quorum.
Yeah.
So at this particular point in time, the floor is open for nominations for treasurer for PSRS STL for January 1st of 25 through December 31st of 25.
I nominate myself.
Okay, we have one nomination, Trustee Doris Walker. Are there any other nominations? Second time, are there any other nominations? Third time, any other nominations? Okay, that being, there being none, then the nominations are closed, and Doris Walker, you win by acclamation.
Thank you,
And
board.
congratulations.
Congratulations.
Okay, and the reason we had to do this early is to make the necessary transitional changes so that we can get Doris on the checks and all the paperwork and get her bonded and all of those things that are necessary for that transition.
So Doris, I'll be in touch with you. We'll need your signature and some other things, but I'll be in touch to get that started. So thank you.
Okay.
Yes.
Doing this so we can get started and do prior to January. And we appreciate Trustee Goodwin and everything she did as a treasurer, and appreciate her service.
And thank you all. Thank you and congratulations, Doris and Sheila. Thank you so much. And we will honor you at the December meeting and all the other trustees. Also, Martell Mann is ending his term. He's not gonna, he said he has 2 children now. He's not gonna be able to be available. So we have a new trustee coming on board from the school board side. And that, Emily, what's her last name?
Weiss, Sadie Weiss.
Wise. Okay, Sadie Wise will be the new board trustee from the board side. So
Who did you say the active teacher is going to be?
Jennifer Orr, she's a special education teacher at Pierre Laclede Elementary.
Oh, okay.
Okay. And they will be sworn in Tuesday at 10 o'clock a.m. at the Civil Courts Building, and I will be in attendance and along with Sue and Ms. Weiss and Ms. Orr. Okay, if there's nothing else, I don't think there is, then we'll ask for someone to make a motion to adjourn.
I make a motion to adjourn.
Is there a second?
Second.
All in favor?
Aye.
Aye.
Hi.
Thank you all so much, and happy Thanksgiving to everyone, and thank you so much for your time. Good night.
Jeff, you're not
Good
driving
night.
back tonight, are you?
No, I've got a meeting up in Collinsville in the morning, so I'm down here tonight.
Well, be safe.
Well, thank you, and everybody have a great Thanksgiving.
Yes.
You too.
Happy holidays.
Happy
Thank you all.
holidays.
Thank
Thank you
you.
all.
Thank you all as well.